Preparing for a FP&A analyst at Metro interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to join Metro as an FP&A analyst? I want to join Metro because its wholesale model combines recurring professional customers, physical stores, delivery, and digital channels, creating interesting planning questions. My strength is translating financial data into practical actions for commercial and operational teams. I would bring disciplined forecasting, clear variance analysis, and strong Excel or system skills. I also value an international environment where assumptions differ by country. This role appeals because FP&A can directly influence growth, margins, working capital, and customer economics. While answering, connect Metro's wholesale, multi-channel, and international operating model with your analytical strengths, commercial curiosity, stakeholder skills, and motivation to turn financial information into better business decisions. Question 2. How would you explain the role of FP&A to a non-finance manager at Metro? I would describe FP&A as the function that helps managers understand where the business is going and what actions can improve results. At Metro, that could mean explaining sales trends, gross margin movements, labor costs, inventory, or delivery economics. I would combine actual results with operational drivers, challenge assumptions constructively, and present the implications clearly. The objective is not to produce a spreadsheet. It is to support better decisions, accountability, and timely course correction across the business. Make sure to cover planning, forecasting, performance interpretation, decision support, business partnering, and communication. Emphasize that FP&A is not merely reporting historical numbers or controlling departmental spending. Question 3. Walk me through how you would build an annual budget for a Metro country or business unit. I would begin with actual performance, current year outlook, and strategic targets, then build the budget from operational drivers rather than simply applying a percentage. For sales, I would assess customer numbers, visit frequency, volumes, pricing, promotions, and channel mix. Costs would include labor, rent, logistics, shrinkage, technology, and overheads. I would involve business owners, challenge assumptions, create base and downside scenarios, reconcile submissions, and document the drivers behind the approved plan. In your answer, discuss the timetable, prior year baseline, volume and price drivers, customer and channel assumptions, cost center submissions, scenarios, review cycles, consolidation, and ownership of final assumptions. Question 4. What is the difference between a budget, a forecast, and a long-range plan? A budget is the approved financial plan for a defined period and usually establishes performance expectations and resource allocation. A forecast is an updated estimate of likely results using current information, so it should change when market conditions or operating assumptions change. A long-range plan looks further ahead and links financial outcomes with strategic choices such as expansion, channel development, or productivity. In practice, I would use the budget as a benchmark and the forecast as the decision tool. Be sure to distinguish purpose, timing, flexibility, and level of detail. Explain how budgets establish accountability, forecasts update expectations, and long-range plans connect performance with strategic direction. Question 5. How would you investigate a significant sales variance at Metro? I would first validate the data, timing, currency treatment, and comparison basis. Then I would decompose the variance into customer count, visits, volume, price, product mix, promotions, and channel effects, ideally by store, delivery operation, or country. I would speak with commercial and operational owners to identify the business cause rather than stopping at the numerical result. Finally, I would assess whether the issue is temporary or structural, update the forecast, and recommend actions. Focus on decomposing the variance into volume, price, mix, customer, country, channel, and timing effects. Mention data validation, stakeholder discussions, root cause, forecast implications, and corrective actions. Question 6. Suppose sales are above budget but EBIT is below budget. How would you explain it? I would avoid assuming that higher sales automatically create higher EBIT. I would bridge sales to gross profit first, testing whether discounts, promotions, product mix, or supplier inflation reduced the margin rate. Then I would review labor, logistics, energy, occupancy, shrinkage, and other operating costs for overspending or poor leverage. I would also check one-off items and timing. My conclusion would explain both the revenue success and why its profitability conversion was weaker than planned. Discuss gross margin rate, product mix, promotions, supplier costs, labor, logistics, shrinkage, occupancy, exceptional items, and operating leverage. Distinguish favorable revenue performance from weaker profitability quality. Question 7. What KPIs would you monitor for Metro's wholesale business? I would monitor sales growth, like-for-like performance, customer count, visit frequency, average basket, and channel mix to understand demand. Profitability measures would include gross margin rate, contribution, EBIT, and cost-to-sales ratios. Operationally, I would track availability, inventory days, stock turns, shrinkage, fulfillment costs, and delivery productivity. I would connect those indicators rather than reviewing them independently. For example, stronger sales with falling availability or rising inventory may signal future margin and cash problems. Mention financial and operational measures including sales growth, like-for-like sales, gross margin, EBIT, customer count, basket size, visit frequency, inventory, availability, shrinkage, working capital, and cash conversion. Question 8. How would you forecast sales for a wholesale retailer such as Metro? I would use a driver-based approach rather than applying one growth rate. A useful starting point is customer activity multiplied by visit frequency and average basket, with separate assumptions for price, volume, mix, promotions, and channel. I would incorporate seasonality, holidays, inflation, competitive conditions, and known commercial initiatives. Forecasts should be built at a practical level, reviewed with country or channel owners, reconciled to the total, and stress-tested through upside and downside scenarios. Explain a driver-based model using customers, visits, basket value, prices, volume, mix, promotions, seasonality, channel, country, and external factors. Include scenario analysis and regular forecast updates. Question 9. How would you analyze gross margin performance at Metro? I would start with a gross profit bridge separating sales volume, price, purchase cost, mix, promotions, supplier income, markdowns, and foreign exchange effects. I would analyze the result by category, country, customer segment, and channel because an aggregate margin can conceal important shifts. I would also distinguish timing from permanent changes, such as a temporary promotion or a structural cost increase. Finally, I would discuss actions involving pricing, sourcing, assortment, and promotional discipline with commercial stakeholders. In your answer, cover margin bridges, product and customer mix, pricing, promotions, purchase costs, foreign exchange, supplier funding, markdowns, shrinkage, and whether changes are sustainable. Question 10. What is working capital, and why is it important in Metro's business? Working capital is the cash tied up in operating assets and liabilities, mainly inventory, receivables, and payables. For Metro, inventory must support availability and customer service, while excessive stock increases cash usage, markdowns, and obsolescence risk. Receivables depend on customer credit terms, and payables reflect supplier agreements. I would monitor days and cash movements, investigate changes by business area, and balance cash improvement against availability, supplier relationships, and the commercial need to serve professional customers reliably. Be sure to define inventory, receivables, and payables. Explain cash conversion, supplier terms, stock availability, fresh product risk, customer credit, liquidity, and the trade-off between cash efficiency and service levels. Question 11. How would you build a monthly management reporting pack for Metro leadership? I would design the pack around decisions rather than data volume. It would include sales, gross margin, EBIT, costs, working capital, cash, operational KPIs, and actual versus budget and forecast views. Significant variances would have concise bridges explaining cause, impact, owner, and action. I would show trends and risks, not just the current month, and ensure definitions reconcile with the general ledger and approved reporting hierarchy. The final pack should let leadership identify priorities quickly. Discuss concise executive reporting, actual versus budget and forecast, KPI trends, variance bridges, risks, actions, data controls, consistent definitions, and tailoring detail to senior decision makers. Question 12. Tell me about a time you improved a financial reporting or forecasting process. In a previous role, the monthly forecast relied on manually combining several departmental files, which created delays and inconsistent assumptions. I mapped the process, standardized the input template, added validation checks, and built a controlled summary model using formulas and pivot tables. I also agreed submission deadlines and ownership with each department. Reporting time fell from 3 days to 1, and review discussions became more focused because variances were traceable. I documented the process so it remained repeatable. Use a clear situation action result structure. Quantify time saved or accuracy improved. Explain the original weakness, your technical and stakeholder actions, controls added, and how the improvement was sustained. Question 13. How would you assess whether a new Metro delivery initiative is financially attractive? I would compare incremental benefits with fully loaded incremental costs. Benefits could include additional customer sales, retention, basket growth, and contribution margin, while costs might include delivery labor, vehicles, fuel, technology, warehouse handling, marketing, and capital investment. I would test cannibalization of store sales and calculate contribution, payback, and cash impact. Sensitivities around order density, average basket, fuel cost, and utilization would show whether the initiative remains attractive under realistic downside conditions. Mention incremental revenue, gross margin, customer retention, delivery and labor costs, technology and CapEx, working capital, cannibalization, payback, sensitivity analysis, and strategic benefits. Question 14. How do you handle an incomplete or unreliable data set when a forecast is due? I would first identify which fields are missing and whether the issue affects the conclusion materially. I would validate available data against the general ledger, prior periods, operational reports, and business owner knowledge. Where assumptions are necessary, I would use a transparent methodology, document it, and provide sensitivity ranges rather than presenting false precision. I would communicate the limitation early, agree a temporary solution with stakeholders, and create a follow-up action to improve the underlying data. Focus on identifying gaps, validating source systems, using transparent assumptions, triangulating with historical and operational data, documenting limitations, applying sensitivities, and escalating material uncertainty promptly. Question 15. How would you account for foreign exchange in Metro's planning and performance analysis? I would distinguish transaction exposure, such as purchases or costs in another currency, from translation exposure when local results are converted into group reporting currency. For planning, I would document budget exchange rates and compare actual performance both at reported rates and constant currency. That separates operational growth from currency movements. I would also quantify sensitivity for material currencies and explain whether FX affects revenue, margin, costs, balance sheet values, or cash, avoiding misleading performance conclusions. Explain transaction and translation exposure, constant currency analysis, budget rates, actual rates, local versus group reporting, sensitivity, and separating FX effects from genuine operational performance. Question 16. What would you do if a senior commercial manager challenged your forecast assumptions? I would treat the challenge as an opportunity to improve the forecast, not as a confrontation. First, I would understand the manager's operational evidence and clarify which driver differs: customers, volume, price, mix, timing, or costs. I would compare that view with historical trends and available pipeline information, then model alternative scenarios. If evidence supported the revision, I would update the forecast. If uncertainty remained, I would present both cases, document the assumptions, and agree monitoring indicators. Emphasize listening, evidence-based challenge, shared definitions, operational drivers, scenario analysis, respectful communication, documented ownership, and willingness to revise assumptions when credible evidence supports change. Question 17. How would you use Excel or financial systems to improve FP&A efficiency? I use Excel to structure driver-based models, automate repetitive calculations, and make assumptions visible. Depending on the data, I would use Power Query, pivot tables, XLOOKUP, SUMIFs, and scenario controls, while keeping inputs, calculations, and outputs separate. I would reconcile totals to source systems, protect formulas, label versions, and document refresh steps. Automation should reduce manual risk, not create an opaque model. I would also learn Metro's ERP and reporting tools quickly. Mention structured models, Power Query or equivalent tools, pivot tables, formulas, scenario controls, reconciliations, version control, automation, auditability, and avoiding unsupported complexity or uncontrolled spreadsheets. Question 18. How would you evaluate a store opening or major capital investment at Metro? I would build an incremental cash flow case covering sales ramp-up, customer acquisition, gross margin, labor, rent, utilities, logistics, marketing, initial inventory, and capital expenditure. I would assess cannibalization of nearby operations and include a realistic opening curve rather than assuming full productivity immediately. The decision would use NPV, IRR, payback, and downside sensitivities for sales, margin, and costs. After approval, I would compare actual performance with the investment case and explain deviations. Cover incremental sales, contribution margin, operating costs, CapEx, working capital, ramp-up period, cannibalization, NPV, IRR, payback, sensitivities, and post-investment performance tracking. Question 19. What controls would you apply to ensure accurate FP&A reporting? I would build controls into the process rather than rely only on a final review. Key controls include reconciling reported totals to the general ledger, checking completeness and unusual movements, locking approved assumptions, maintaining version control, and using consistent KPI definitions. Material variances should have documented explanations and owner sign-off. I would also separate preparation from review where practical and retain an audit trail. Strong controls improve confidence without making reporting unnecessarily slow. Discuss reconciliations to the ledger, completeness checks, standard definitions, review sign-offs, access controls, version management, variance thresholds, documented assumptions, and segregation between data preparation and approval. Question 20. What would you prioritize in your first 90 days as a Metro FP&A analyst? In the first month, I would learn Metro's business model, reporting calendar, organizational structure, systems, KPI definitions, and key planning assumptions. During the second month, I would take ownership of recurring reporting, reconcile outputs, and meet commercial and operational stakeholders to understand the drivers behind results. By the third month, I would deliver reliable variance insights and propose one or two practical improvements, such as automation or clearer forecasting inputs. I would prioritize credibility before redesigning processes. Outline a phased plan. Learn the business and reporting calendar, understand systems and KPIs, build relationships, validate data, deliver reliable analysis, identify process improvements, and avoid changing processes before understanding them. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.